Hello, everyone, and welcome to Financial Accounting. Have you ever wondered how depreciation and amortization actually differ and why it matters for companies' finances? You are not alone. I'm going to break down the difference between depreciation and amortization in a way that makes it super easy to understand, so you can finally get a grip on these accounting concepts. Before we get started, thank you for liking and sharing this video. It really helps out this channel. Please consider subscribing so you don't miss new videos. Oh, by the way, where are you guys watching from? Let me know in the comments below. I'd really like to know. Depreciation and amortization are two key concepts in accounting and financial reporting that help businesses and individuals understand the value of their assets over time. They play a crucial role in calculating profits, losses, and overall financial health. The confusion between depreciation and amortization is more common than you might think. Many people use these terms interchangeably, but they actually refer to different processes. This mix-up can lead to inaccurate financial reporting, which can have serious consequences for businesses and individuals alike. It's essential to grasp the difference between these two concepts to make informed financial decisions. The main reason it's critical to distinguish between depreciation and amortization is that they apply to different types of assets. Understanding which one to use can save you from a lot of trouble down the line. Incorrectly classifying an asset can throw off your entire financial picture. Imagine making financial decisions based on incorrect data. That's a recipe for disaster. Depreciation refers to the decrease in value of tangible assets, such as buildings, machinery, or vehicles, over time due to wear and tear, obsolescence, and other factors. On the other hand, amortization applies to intangible assets like patents, copyrights, or trademarks. For example, if a company buys a piece of equipment for $10,000, it would depreciate the value of that equipment over its useful life. Similarly, if a company purchases a patent for $50,000, it would amortize the cost of that patent over its useful life. I have several videos explaining how to calculate depreciation and prepare a depreciation schedule in Excel. I am posting the link to the playlist here and in the description below. A key difference between depreciation and amortization lies in the way they are calculated and reported on financial statements. Depreciation can be calculated using various methods, such as the straight line method or the accelerated method. Amortization, however, is typically calculated using the straight line method. Both depreciation and amortization have a significant impact on a company's financial statements, particularly on the income statement and the balance sheet. The types of assets they apply to and their impact on financial statements are what set depreciation and amortization apart. Depreciation affects tangible assets and is often used to match the expense with the revenue generated by the asset. Amortization, on the other hand, applies to intangible assets and helps to spread out the cost of the asset over its useful life. Understanding these differences is vital for accurate financial reporting. If you would like to learn more about amortization, I have a video explaining what amortization is and how to prepare an amortization schedule in Excel. I am posting the link here and in the description below. Now, let's look at a couple of examples. Assume that Mega Corporation purchased equipment that costs $10,000 on January 1, 2025, and estimates that the equipment has a useful life of 10 years. Mega depreciates this equipment over a 10-year period. At the end of 2025, Mega reports the book value of the equipment as follows. Equipment $10,000, accumulated depreciation equipment $1,000, and book value $9,000. Unlike with amortization, a company may choose the depreciation method that best fits its business needs. Depreciation attempts to recognize the cost of an asset in the periods that benefit from the use of that asset. The following depreciation methods can be used: activity method or units of use or production, straight line method, decreasing charge methods or accelerated methods, including sum of the year's digits and declining balance method, and group and composite methods. Depreciation expense is recorded as a debit or increase to the depreciation expense account, and a credit or increase to the accumulated depreciation account, which is a contra asset account. If Mega purchased a patent, the amortization would be recorded as a debit or increase to the amortization expense account, and a credit or decrease to the patent account. Note that the company may credit amortization of patents directly to the patents account, which is most common, or to an accumulated amortization account. To recap, depreciation and amortization are two distinct concepts that are essential in accounting and financial management. Depreciation refers to the decrease in value of tangible assets, while amortization applies to intangible assets. Understanding the difference between these two concepts can help you to make informed financial decisions and ensure accurate financial reporting. If you've got questions or experiences with depreciation and amortization that you'd like to share, please leave them in the comments below. If you are looking to brush up on your accounting basics, be sure to check out my related videos on this topic. Thank you all so much for watching, and I hope to see you all again in the next video.